What I think is going on in the market. Specifically, we had a daily signal, market top signal, back in the early part of the year, which I'll show you. We had a weekly signal start to form in around about March, and that failed. We got another one that's likely to be forming this week and next week, provided the markets don't drop suddenly. And I'll show you those as well. So the market top signal doesn't mean it's going to drop right now. It could take a few weeks to a few months for it to finally roll over, but it means the market now is in an unstable state and probably will head down at some point. So this is a little cartoon that I've been showing for the last few meetings. The new president coming in, the bulls are rallying behind Donald Trump up to a high level. The Dow's reached 21,000. In fact, it's a little bit higher now. It's over 21,300 and likely to get to 21,400 potentially in the next few weeks by the end of June, start of July. From here, though, I do think we'll see a correction. I'll show you why. Anything up to about 10%. At one stage, I thought maybe we'll between 10 and 20%, possibly not in a bear market. But it all depends on whether any of the legislation that Trump's really trying to push through can get done this year. If it gets pushed off into next year with all the shenanigans that are going on, then that might cause a problem. We might see a big unwind of the market as it is right now. So it could be down into the 20 to 29% drop. Wow. So this is going back a few years. This is a weekly chart of the Dow Jones 2013, 14, 15. This is a signal that I developed. It came in June 2014. It told me that a top was coming. From that, I could work out areas of probability where a top was likely to happen, and these are come out in windows of anything from a month to 3 or 4 months wide. Some other windows existed. We'll come to those later on. They were off the screen at the time, but we actually come to them with further versions. And on the daily charts, which are in blue, so the work on the weekly charts are in red, the daily charts are in blue, they're labeled A and B. Where window B and window 4 overlapped, it made a likely point for a top, and some of the other indicators I had suggested that, and sure enough, the market topped out, the Dow and the S&P 500 in May of 2015 inside window B and 4. Other key indices also topped out. They topped out a little bit later in July and June, but all the key US market indexes topped out in window 4. We came down through the end of that year and then into early part of last year, and it looked like we were going to be in trade range for a while, but we came out of there. Window 5, as I talked about before, was in the early part of last year. We came up, formed a lower high at that point, but then went a little higher from the Brexit vote and formed a new high altogether on the Dow. That crossed out windows 4 and 5. We knew those wouldn't be the top, and then I had a window 6 opportunity in the later half of last quarter of last year. And I said at that point, even though we came down just before the election, we were probably going to bounce up, and at some point, no scale involved here, but at some point we would come down. Didn't know when that would be, but we'd have that kind of a pattern. It might happen in that quarter or earlier this year. And as we know, we've gone higher from this point. And the window 6 and C looked like the March top could have been the top, but we've actually gone higher from there. This is the daily signal that I talked about. So on the daily charts, you've got a pretty reliable signal telling you something is very unstable in the market. It's top heavy and it's likely to come down at some point. We also had a weekly signal. It hadn't fully formed at this point at the April meeting, and shortly afterwards it failed because of a downward move in the markets. So that got taken off the board. We come up the last couple of months since the last meeting, and then another signal is now almost there by the end of next week. Provided the markets don't drop suddenly, that signal should complete. And that's exactly the same as this type of signal here. So this signal we got back in middle of 2014 has appeared again, along with the daily signal. So I've got windows 7 and D now over June and July this year. Let's move on. So June and July as possible points where we could see a final topping out of the Dow. But I don't know yet whether we'll get windows beyond that or whether that's it. Certainly some of the indicators I've got are suggesting something around about June and July could happen. The other thing we're seeing is actually this week, the DAX and the NASDAQ and the S&P 500 are both potentially topping out with the same signal, but a week earlier than the Dow. Provided we don't get a big drop tomorrow. We had a bit of a drop starting today, but the market climbed back up. Provided we don't see a significant drop tomorrow, then those should signal a weekly top signal as well. So we start to get all of the indexes starting to chime the same tune at the same time. And also looking at the DAX in Germany, that also has the same type of pattern that should finish, I think, in line with the Dow. So that could finish next week, provided the DAX does not drop suddenly. Then the DAX will also have the same type of signal forming next week as well. And so something I said earlier on before we decided, the huge volume you see down there, it's been at a certain level and then jumps up suddenly. And we talked about this before. Somebody somewhere is selling an awful lot, even though the market's slowly creeping higher. They're doing it in a stealth fashion. And that means that they're getting rid of inventory potentially, but doing it in such a way the market can still creep up higher. But there's a serious change in volume there over the last probably 3, 4, 5, 6 months.
So you think that indicates selling?
I think so.
Yeah.
I think so. And we'll see in the next couple of months if it comes down. Now, this is a table of 14 instances over the last 90 years where we get both a daily and a weekly signal on the Dow. As you can see, some of the key drops that we've actually lived through, 2007, 2000, some of us as well, 1987, that was the crash, and some that we've only read about in the textbooks maybe, and that was the Great Depression, when in 1929 the market dropped 9%, and 1937, a few years later, it dropped 50% again, having climbed out from the bottom of the depression, it dropped again 50%. So there's some significant drops happen when we get two signals, but not always. We can sometimes have something as small as 12% or 14%. But certainly something in the range of 12 to 20% could be possible based on these two signals coming at the same time. Remember, the weekly signal for Dow hasn't happened yet. We still have to get to the end of next week, and I'll send out a message if we get there and that signal forms. And it certainly means we could have something happening in the coming months based on this historical perspective. This is another pattern I'm looking at. I've showed the last few meetings. It's a quarterly chart of the Dow showing candlesticks which each are 3 months long, and it shows quite a long way back to 2007. That's the top that we all experienced back in October 2007. That's the bottom in March 2009, and then we see the long rally from that point upwards. It's a 3-phase pattern that I follow. Phase 1 is a change in direction. Phase 2 is 9 candlesticks all growing in a certain progression at an accelerated rate, and then a consolidated rate of 13 candlesticks. And this is phase 3. It usually gets to 13 candlesticks. It got to candlestick 12 at the end of 2015. And just a few months earlier, the Fed had stopped its QE3 program, and it looked like that might be a point where the market would come down. And that's where the previous signal back in mid-2015 had happened. And that looked like that might be the point where the market might roll over significantly. In the end, it rolled over, but selling came back in and drove this pattern to completion. So that's where we saw the Brexit form an all-time closing high in the quarterly chart, end of Q2 last year, and then formed candlestick 13 as we got towards the end of last year. So that was our full phase 3 completed. And from that point, often you'll see a downturn in the market, and I'll show you a table of that data next. And again, we've got this general downtrend in volume, but that peak at the bottom, it's only one spike here because it's a quarterly chart. But that's part of what the volume we saw increased on the previous chart. So taking that particular pattern and looking back over the last 100 years, I've drawn a table. So this is the one we're seeing at the moment. This is where Count 13 completed Q3 last year. And the market top, this is where we were last meeting in April. We'd actually only gone 2 quarters beyond it. That's actually +3 now, but I'll leave it there for the moment as I talk through the table. We don't know where the market low is going to be. It hasn't happened all the percentage drop. But for each year this has happened, in 1997, the top formed in Q1. The pattern formed in Q1. The top formed 2 quarters later. The bottom formed 3 quarters later, and the drop was 17%. That's the way that the table works. Coming down over the last 100 years, all the way back to 1915, there's 11 instances where this has happened. Now, if you look at the particular table column here, apart from that +5 after the Second World War, usually it was 1 plus 0 plus 1 or plus 2 quarters afterwards. And last meeting we were in that sort of phase, so it looked consistent. We have actually gone 1 quarter beyond that. Looking at how the bottom forms, the bottom normally forms 1, 2 or 3 quarters later than the top, except for 2 cases where it was 6 quarters later, and that was 76. There's a big drop in the market back at the end of 66 as well. It took 6 quarters for the bottom to form. And you can see all the various drops from 10% up to 29%. So there's a range of percentages, but all fairly significant in downturn. If we look at those cases, because we know at the moment we're sort of +2, +3 quarters beyond the top. Looking at the similar cases here, +2, +3, +5. Looking across to the drop, you see 17, 17, 20, and 24. So that potentially gives us, if you look at if something similar happens this time, from going higher than the actual pattern finishing, we could end up with a drop somewhere between, say, 17 and 29%. The other thing I looked at was where the actual quarters, where the actual tops form, quarter by quarter, and I formed 4 columns here. Each of the quarters. Last meeting, the top was actually in Q1 in March, so I had it there. It looks a little lonely in that column. All the other tops seem to be in Q2, 3, and 4. And sure enough, we've seen over the last couple of months that that's now gone. If we look at that box there, that's actually now +3, and we've had the recent highs in the Dow, and that moves the top over into Q2. So actually, we've had in over 100 years, we've not had this pattern top out in Q1. So we're now in Q2, potentially Q2 or Q3, so something over the next few months could be where the top forms. But we're certainly in a range where between now and the end of the year, which will be +5 for us at the moment, the top is likely to form based on the historic data. Very quickly looking at a couple of models. I have one for a flash crash predictor and one for a bear market, serious downturn market recession indicator. And this one looks at flash crashes and waterfall drops in the price. Particular model came out with these signals, and it had to, where the 2 circles are, it had to pinpoint 2 cases where we've had flash crashes. And so this seemed to be a fairly good indicator of where flash crashes might happen. I don't fully understand what's causing it directly. There are some indicators that may be behind it in terms of QE ending and other trends. But this model gives us a chance to find out when the next case will happen. So looking just at the last few years, that was the last significant drop or flash crash in August of 2 years ago. From there, we had a signal in January, May, and July of that next year, and we did actually see a drop for that first signal. Since then, the market rallied significantly, as we know, from the low beginning of last year. And as we push out, those signals for flash crash are pushed out to the right. So by the time we get to this point here, which is where we are now, the signals are July and September. In fact, we have 2 signals is quite significant, because usually you only get 1. But 2 together, July and September, means we might get a fairly significant drop sometime soon. And at the point where the market does roll over, that would indicate the potential for a flash crash, certainly a fairly significant drop, a waterfall drop in price through to where those signals are at the moment. Similar, using the same model but in a larger time frame, we're looking at bear markets and US recessions. This is the model for the larger scale. You see signals coming out indicating where serious drops in the market. That's 1987 crash, that's 1990, right. And then we had signals for 2002, and then the big downturn 2007, 2009, and again 2015. Taking this model forward to the future, because we can roll it forward in time, just those last few years. We've got some signal in Q3 this year, which we're about to enter, Q4 this year, and then Q3 next year. So these are potentially signalings, not just on the previous model, that we could have a flash crash or a waterfall drop, but also something much more significant like a bear market or a recession. Looking now at the St. Louis Fed model for US recessions. They have a model. We have on this chart, back to 1970, for the present day, we have the blue bands are the actual recessions as defined by government agency, and the probability is the blue line telling you, the model is telling you a significant chance of a recession, and the blue line does coincide very well with the light blue chart, the light blue periods when recessions actually happen. Going back to the April report, which was dated up to January, there was a small risk that a recession might be starting. But the last report that came out in June, that disappeared. So at the moment, the report is not indicating that there is a recession on the horizon. One thing I'm going to start doing now, presenting each meeting, is a table showing the output from the model. This is where we are now. There's no signals at the moment. If I take this chart, this is a table rather, and go back to the last recession we know about, this is what it actually looks like when the recession is actually happening. So looking at the chart, we've got a line number, just indicating the line in the table. This is the year and month of the report that comes out from St. Louis Fed. This column here is the probability of a recession. It goes from 0 to 100 naturally. And from that probability, I can work out potentially when the recession is likely to happen or when it's in play. This column here is the actual data that's used in the report. There's a 3-month lag. So if you look at November, the data goes back to August of that year, December goes back to September. So the report data is always about 3 months old, so it's a little bit of a lag. Next column is what the National Bureau of Economic Research, NBER, they publish when a recession actually happens. They tell you when it starts and when it ends. They've done that for the last 150 years. You can go to their website, you can see all of their reports on recessions in the US. So that's what they output, and then I try to mimic that based on the probability. And I've got a couple of warning and alert signals that come out. The risk and the alert and the warning come out a little bit early and they end a little later. But the actual key signal is the US recession signal, which in this case was 100% perfect. It matched all of the data values from NBER. And overall, I get about a 97-98% success rate over the last, I think, 40, 50 years. The last column, I tended to come up with a flag that indicates the very ending month of the recession, and quite accurately, this one got it, and most of the other recessions as well. The little flag comes up with usually a month or two to spare just before, and it starts to sense the probability is coming down in a certain fashion, and therefore it understands that the recession is probably coming to an end. So I'm going to start publishing this each month so we can see if a recession does start, have we caught that start in the signal. One thing I saw somebody publish was this particular chart of, they said that whenever a fresh face comes to the White House, there's always recession in the first year. And I didn't think that sounded right, so I did a bit of investigation. They were obviously indicating with Trump coming in, would there be a recession? They actually missed Bill Clinton off this chart. When I looked into the data, it turned out that actually whenever a Republican 4-year presidential period starts, there's always a recession. And that's the first term. And even in the case of the second term, there's always a recession. And the only time in the last 150 years or so, Ronald Reagan's second term is the only time a Republican president's come in and there's not been a recession. So literally every other time there's been a recession at some point during the 4 years. A little bit different for a Democrat president. Looking at some other observations, I've cut this back a little bit from last time. Just looking at the fact that 70% of recessions tend to start in year 1 or year 2 of the presidential 4 years period. The length and frequency of recessions have reduced significantly with the formation of the Fed. It used to be a time that it was 40% of the time the US was in recession. Now it's only about 15%. So despite what you think about what the Fed actually does, it does seem to have provided some kind of a benefit in terms of pulling us out of recession quicker, the recessions lasting less long, but quite a huge factor.
Maybe it's just lying about it.
You're so cynical.
That's my job.
Time between recessions was typically very short during life extension, usually about 2 to 3 years, 24 to 36 months. That's changed significantly. So more recently, we're looking at the 5 longest recessions over the last 157 years, 45, 49, 79, 105, 119 months. That was 1861 to 1865, that's quite a while ago. 33 to 37 after the Depression. 38 to 45, that was just leading up and during the World War. 1961 to 69, and then more recently 1991 to 2001. Just remember that number 119, that's the longest we've ever gone in the US without a recession. Currently we've gone 96 months since the last recession, which ended in June 2009. So in May 2019, not next year but the year after, about 2 years from now, that'll be the absolute record reached. So we either go onto that record and beyond, or we'd like to have a recession sometime soon. But that's the longest we've ever gone in history, and that comes up in 2 years. So that's a milestone. And then looking forward, the next presidential election in 2020 will be 136 months, which is a 15% extension on the previous record. Possible, because that has happened before, but it's certainly a limit. So looking at that, the conclusions are there's a fairly reasonably high probability that we'll see a recession before the end of next year or the next 18 months. That's because recessions tend to happen in year 1 or year 2, and we're getting awfully close to the upper limit of 119 months. Second one, B, is there's a very strong, if we don't hit that one, there's a very strong likelihood there'll be a recession before the next election, because that'll be way beyond the longest limit of 190 months. But finally, with almost certainty, there'll be a recession by December of the 2022, which will be the first 2 years of the next president. So if Donald Trump can actually keep the economy together and there is no recession, the next president coming in has got a very high probability, indeed, that there'll be a recession in those first 2 years. So good luck to them. Looking at GDP very quickly, this is a chart of GDP, comes from the Atlanta Fed. This is the blue band down the middle is just a general consensus, and the green line is what comes out from the Atlanta Fed. Usually comes out once or twice a week, sometimes 3 times a week, as their prediction before the more serious and final readouts come from the government agency. So here we have this is Q1 last year, and a big rise up, rise down. The red number is what they were predicting. The final purple number is what the government agency came out with. It was actually quite close there. Q2 last year, again we had this rise up and rise down. The government agency came out about 0.4% lower. Q3 last year, this was actually quite off. So they were down at 2.1%. The agency came out at 1.4% higher. So that's quite a big miss there. And then Q4 last year,
That was Q3, what was?
that was Q3 last year. They predicted 2.1, but the government
So
said
that was right before the election.
yeah, oh yeah, absolutely.
Things were really, really good, suddenly became
Yes,
really good out
yes,
of the blue.
absolutely. 2.8,
Probably realistic.
that was 0.7 above. Now we come into what's been going on for this year. A very sharp drop down with a very initially a very high estimate, then dropped down to advanced a month ago or 2 months ago was 0.7, preliminary end of last month was 1.2, and the final result comes out in just a few weeks' time at the end of June. So it's a little off. They predicted something low. It's about 1% high at the moment. We'll see whether it goes a little higher, a little lower. And here we are, their predictions for Q2. Started at 4.3, come down to 3.4. A week ago it was 3.0, and then just yesterday it was 3.2. So it's come down again, a similar sort of pattern. It starts high and comes down lower. And we'll see over the next 2 or 3 months what happens to that percentage before we get the final value from the government agency. Looking very quickly at the VIX. I've been tracking this because it's been getting lower and lower and lower, a measure of complacency in the market. There's a particular pattern forming, same as the pattern I've shown you on some of the other charts. You have a phase one, but this is now downwards rather than upwards because the VIX works opposite to the movement in the market. Phase one changing direction, phase two 9 candlesticks coming down, all in a particular pattern, and then now phase three starting, and that has to go to, we're looking for that to get to candlestick 13. There are particular rules for selecting the candlesticks and giving them a number. I won't go into those now, but there are rules. If you're interested, I can give you some books that will actually explain how it's done. Watch candlestick 11, still looking for candlestick 13. This was August last year. We've moved forward into the early part of this year. We actually got to candlestick 13 tail end of last year. The interesting, and actually candlestick 14 as well. The interesting thing coming into this year is that we had on February 1st a low that was 10 years in the making. So value of 9.97 is a low point of the VIX, which the last time it was that low was 10 11 years ago in 06-07. And then more recently, June 9, we actually had a low that's lowest for about a quarter of a century, so back to 1993, 24 years ago. That was a value of 8.89. So the VIX has come down to extraordinarily low levels, and that's a signal of something else unusual is going on. Looking at bond yields, I said back when I first started doing presentations here in 2014 that there would be a possibly double bottom in the yield on the 10-year, and that was when I made the prediction. Sure enough, it had been 1.39 way back in 2012. You can't see that on this chart. However, we got down to just below it, kind of the double bottom. It went kind of 1.34 in middle of 2016. And as Darryl said, a lot of bond yields around the world all kind of dropped to a low point. It was a kind of global event. And again, same thing happened here in the US. It reached that kind of double bottom point. Now the question is whether it'll go down to that low again as a final bottom, or that is the low that we see for the rest of our lives. Because if that's the low and that's it, then we would not probably see it go that low again for the rest of our lives. We'll probably see a steady increase in yields over the rest of our lifetimes. So from that point last year, we've come up significantly, and then this is where we are now. We've come back now. We're still hovering just a little bit above the 2% mark. And I've got a possible window of opportunity for a low point middle of next year, Q2, Q3. We'll see how that pans out. If we do get a drop in the market and people fund for safety, they'll buy bonds which will send yields lower again, so we might see yields come back down again. Currencies, as Darryl said, he asked me to look at Bitcoin. That's become very interesting now because, as Darryl said, it's in a bubble. I'll cover dollar and euro first, then we'll get to Bitcoin. So this is a long-term chart. Actually, I haven't changed this much in the last year. I said that in 2000, when we had the last the downturn in 2002, and also in 2008, 2007, 2009 rather, and where we are now, we had an upward move in the dollar in each cases, and we probably would see an upward move if we saw a drop in the market now. And up until about a year ago, we were at high levels of the dollar compared with back 10, 12, 13 years ago, 14 years ago to 2003. Just taking a look at that last part of the chart, this is what I've been showing you the last few meetings. We've seen that rally up to that point. The pattern here again, looking at the three phases, phase 1, phase 2, 9 candlesticks, and phase 3, is a consistent pattern. We see the same on the euro. Phase 3 got to 8 candlesticks, and usually at that point, because we got such a high value, I didn't think it would carry on going in a trend, but what we might see is a pullback, and then another attempt to take out that high and go a little higher. And sure enough, over the last few months, we've seen that come down on that first line down. Now, that's just an estimate of what's going to happen, a downward move and upward move. I don't know whether it's going to end at that point where I've created it. It was just a general attempt to say what's going to happen next. It could go on going down for quite a few months beyond that. That's a rough trend of what I think is going to happen next. What might drive the dollar higher? It could be a downward move in the equity markets and a flood into treasuries. We've said before the euro is a mirror image, so if you go to the euro, we see a mirror image of that. We see a phase 1 this time downwards, phase 2, 9 candlesticks, phase 3, 8 candlesticks so far. And I said, as a mirror image to the dollar, we'll probably go up a little bit from that low point and that down, and that's what we see. We've actually gone up. Here we are in June. We've actually come up a little bit off that low point. Now, this is Bitcoin, the exciting bit. It's new, we haven't covered this before. Alvarez. Yes, you asked the question. What's going on with Bitcoin? Well, this is what's going on with Bitcoin.
Well, Japan was going to change over to Bitcoin.
I doubt that. So, classic exponential curve upwards, going to infinity. This is a bubble. One of the key models I have requires about 4 to 5 years minimum. So, because it's not 4 or 5 years data, I can't run the model. But it certainly looks and smells like a bubble. In fact, it's going up to infinity. Something that Daryl pointed out to us back when China was in a bubble a couple of years ago. He said, oh no, so before I get to that, so this last sort of part of the upward curve is the phase 1 and phase 2 9 candlesticks. I don't know if it'll get to phase 3 because it's going off exponentially, so I don't think it'll ever complete phase 3, but it might actually come to a point, an end at the end of phase 2. Sometimes at the end of phase 2, you can get a change in direction, so the market may come down from here, which is why I said that last week or this week we might see the trend break and come down. But going back to what Daryl said a couple of years ago with China, he did say, look at the RSI, and when it goes significantly over 80, that's a sign of a bubble on the weekly chart. I think you said that, and that's what we're seeing here. You see a very significant increase here, a rise over 80, same again, end of 16, early 17, and then even higher now. So it certainly looks like a bubble. Someone asked me earlier on, would you buy Bitcoin now? I said, absolutely no way. Because unless you're a very adept trader, you probably get caught quite badly on the downward move. When it's going to happen, I don't know.
I think it's under 2,000. You know what it is?
No, I don't know this right now.
Say again?
It just had a big drop the last few days.
Yeah, well, this is the weekend. I did some of the charts at the
Well, I think
weekend.
it went to around 2,000, so it's already gone.
2,300.
2,300 is the bottom.
So it's come down to about here then.
2,100 this morning.
2,100?
This morning.
Yeah, it's around
Back, back
25%
a
from the
little
top,
bit.
right?
Yeah.
Because I read this, I get this continual stream on Twitter forever.
So,
So like 2,100 from 2,800, that's it.
as you say, 25.
And it's not even what you have in a day, it's
Yeah, it's happening in
recent.
days. And I said
It's not even on your
last
chart.
week or this week it would possibly happen. So, but we don't know whether that's because sometimes with bubbles you get a drop down
And you
it
don't
can
know
spike
much.
even higher.
You don't
So
know my chart, tell them that.
Yeah, yeah. So
I'm well aware
it's
of it.
extremely dangerous to get into a bubble once
Well, if
it's in
you're
the
great-
exponential
If
phase.
you're a great trader, you can make.
Oh
it.
yeah, yeah. If you,
But notice how many gaps are on this.
oh yeah,
chart also.
yeah, and they've all got to get filled.
Well, we just apparently,
Filled
we're trying to
some.
fill that 2,000 gap.
Yeah,
We filled the top one, but there's a gap at 1,400
yeah.
that needs to be filled at some point, so. This is a very dangerous job.
Yeah. That's right. So I did say that certainly over June, July. Similar with some of the other things that are happening. So we're seeing potential tops forming on the equities. a bubble here, we'll see bubbles in Venezuela and Argentina, I shall show you. So there's an awful lot happening, and it looks like it's coming to a crescendo or a head over the late spring, early summer. So beware. We're not going to meet again until August or September. A lot could happen between now and the next meeting.